Hello everyone, welcome back to the channel. Today I'm going to be breaking down a trade that was sent to me by a student that I'm currently mentoring that is part of our mentorship group. He did send out his chart with his markings out, and you can see the date and time that he sent it, so there's proof of that. And I did actually personally take this trade, and you can see the price at which I entered, which is the exact same price that I am going to be showing in the video. We are going to be looking at this trade from both the Wyckoff and our smart money and Wyckoff and our order block point of view. We did have a nice Wyckoff distribution schematic that made our order block trade have a higher probability of being a successful trade and better quality of trade overall. So yeah, now that all of that has been said, I'm just going to delete everything off my chart, retrace the market or bring the market back here, replay the market is what I meant, and go back up to the 1 hour time frame. On the 1 hour time frame, what did I notice for Chaff JPY if it wants to load up? I noticed that Chaff JPY ever since basically the beginning of December has been in a ranging market. We had this massive range that before that we had our rally, then what we are having is our base. We want to then get a drop back down that will fill imbalances that are down here, because there are always going to be imbalances that need to be filled. And if I show you, we have this massive imbalance that you could argue is an imbalance that the market needs to come back and fill, right? So I had that higher time frame bias that the market needed to at some point come back and fill certain imbalances, and then maybe continue going upwards. We don't care what happens afterwards, but we need to see the market come back down in the short term. That was my higher time frame bias. I did also believe, because we had a breakout of structure, so if I just show you, we had this previous structure be made, right? The market broke out of that structure, so the market might have to return back to an order block that's here. So this whole area that I have shaded out in blue, the market might have to come back into before then the market drops off, which is what we were expecting to happen and what we wanted to happen. So we had this whole area as an area of as a potential order block that the market could then break structure to the downside, which is what it did, come back and then drop off, which is what it did. But you know, I don't have that on my chart yet, so I'm going to show you that later on. So that was my higher time frame bias. I then also went down to the 30-minute, and what I noticed was on the 30-minute we had some previous structure that we had liquidity above. So we had this level of structure the market had tested twice that retail traders are going to be thinking, okay, if it tests again, we need to sell at. So obviously, as we know, if you haven't watched the video about liquidity, go watch that. Will be in the top right corner of the video. But I did a whole video about liquidity and where liquidity is going to be sitting in the market. There's always going to be liquidity sitting above levels like this, levels of resistance, levels of support, even trend lines. There's always going to be liquidity above these types of zones. So we understand there's going to be liquidity, and therefore smart money might want to push the market out of those zones and then let market do its thing. Another thing that I noticed on the 30-minute was that we had a little the bullish pressure was slowing down. What do I mean by that? I mean the market was forming significant higher highs, higher lows. So we had this high, right, and then this is what we had this high, then the market formed a higher high, higher high, higher high. Now guess what? The market is not forming higher highs. So what we saw is the market momentum, right? The bullish momentum or the bullish pressure to the upside. I mean, bullish refers to upside. So bullish pressure is decreasing because we are no longer seeing higher highs and higher lows form. So this high, then this high is higher, this high is higher, this high is even higher. Then we have close to equal highs. That suggests decreasing momentum. Another thing that I noticed was a Wyckoff distribution schematic was forming, right? So if I just show you, we had this little area of preliminary supply. So if I just mark it out for you, preliminary supply, bias climax that accumulated liquidity, right, at that double top, at that level of structure from before that had formed on the 19th of February. So the market accumulates liquidity above that zone or at that zone, right? So this is our bias climax. We then had our automatic rally, which is like the retracement that happens after our bias climax, liquidating or mitigating liquidity below these lows right here. So we had this low there. The market then took out that low and took its liquidity through this automatic rally. We then started to look for our upthrust and our UTAD and our last point of supply and our sign of weakness. Our sign of weakness showed right here. If I show you, it wasn't as, I didn't like it, I can't lie, because it didn't break structure. Normally what we look for is for a sign of weakness to break structure, liquidate liquidity above, below our automatic rally. So then the market can go back up, take out liquidity to the upside and then drop off. This was our sign of weakness, although it didn't take out liquidity. So this was our sign of weakness. I call this my upthrust because it took out liquidity above this triple top. So if we go on to lower time frames again, maybe let's go on to something like the 5-minute time frame. You will see on the lower time frames, this was a clear area of resistance that people are going to be selling at. So we have this low area of resistance. People are going to be seeing, okay, market has come there, market has come there again. When the market goes there again, we need to sell this. We need to sell chaff JPY. Market then doesn't do that; it smashes right through that. So this is what I called my upthrust. So if I go back up to the 30-minute, and then we go right. So this was my upthrust. I was then looking for where to call my UTAD. I call this my UTAD. Why? Because it took out all liquidity and made a new high. We had this high be broken out of. Right, so we had this high be broken out of. Where else did we have broken out of? Obviously our high from the upthrust. So our upthrust, this other high that was formed, and then we had that breakout to the upside. So this is what I called my UTAD. We then now have a valid Wyckoff distribution schematic. Why is it valid? Because from our UTAD, what do we look for? We look for the market to break structure to the downside. And if I play this market, you'll see the market does exactly that. Market continues going to the downside. Therefore, this UTAD is a valid place. But then we understand that the Wyckoff is not complete yet. Why? Because we haven't had our last point of supply fall, right? We want to see our bias climax, automatic rally, secondary test, a sign of weakness, upthrust, UTAD, and then our last point of supply. Our last point of supply is the last point that the market will come up to and then drop off. We don't want the market going any higher than our last point of supply, right? Say this is our last point of supply. We don't want the market going like breaking that structure or anything like that. That's where we want to enter off, because that will be the place where we are most sure the market won't stop us out from, right? So what did I notice? I noticed this right here. I noticed that when the market formed this UTAD, it left behind this massive order block, this whole zone, right? So that whole zone is an order block that the market could then, leave that order block, right? So it could go away from and then return to and then drop off. So that's where we could get our entry. So that's exactly what I did. I marked out that order block. So I drew it out, right, with these the ray tool, and then I used my rectangle to just make sure I can see it. And then what you can do is you can even extend that to the right so that it stays all the way to the right, so that when the market comes back you can see it. Then what I did was, I went to the 1 hour time frame, right, waited for the market to come back, right. I think it does break some structure to the downside before it does. This is our order block that it then went and mitigated. So we had this order block, our bullish order block on the lower time frames. Market came back to that order block. You'll see it tested the wick, it looks like, right? Tested that wick, then went flying up to our entry price. You'll see exactly what it did. It went to our entry price, drops, right? Entry price and then drops. Market tests it multiple times. There's another form, right? This is more confidence to our trade, because you'll see, look, market form, high highs, high lows, massive engulfing candles. Massive engulfing candles. Now the market, if we look at it from like without like a high highs, high lows type of structure, the market is losing momentum. Our bullish candles are no longer as big as they were here, right? We have this massive bullish bullish engulfing candle. Now the market has slowed down immensely, right? So this is what we call losing momentum, adding more confidence to our trade, that when the market comes and taps our entry price, market should just drop off all the way down. And guess what it does? If I play this market from that entry price, I think we're in drawdown for like a couple of pips. Actually, no, we're not. Look at that. Lovely trade from my order block, just completely drops. Amazing trade. I didn't actually enter from that order block. I entered a bit lower. So if I show you my price, I entered at 117.837, which is basically at the top. So if I just show you 117.837, I entered 837. That's where I entered. So I entered right at the top, basically. Snatched that wick. Then the market just completely drops. Where did I target for this trade? If I just show you where I entered, so that was my entry price, right? My stop losses for this trade were a bit big. I cannot lie. For the usual that's on these my videos like this, what we have is 1 to 20 risk to rewards, 1 to 30 risk to rewards, 5 pip stop losses, 10 pip stop losses at max. This stop loss was a 30 pip stop loss, and you have to deal with those trades. They do exist. I know that when you watch smart money videos, and that some of you, when you're trading smart money, only look for 1 to 30 plus risk to rewards. This is a trade that I had to deal with a 1 to 4 risk to reward. And you know what? That's fine. As long as you know how to manage your risk, which is what I'm about to go through right now, then 1 to 4 risk to rewards, even 1 to 1 risk to rewards are fine with 60 pips stop losses. If you can manage risk, it's fine, right? So this is what I did. And I entered right here, so with half of a lot, because right now I'm doing an FTMO 10k account that I'm going to be announcing on the YouTube channel. It's a challenge that I'm doing. So yeah, that's your sneak peek. I'm doing a 10k. I'm going to be trying to pass it in a week. This was basically half of the challenge already done, right? What was I talking about? I was back on this chart. I was talking about how I entered with a 0.5 lot. How did I manage that risk? That 0.5 lot worth of risk. As soon as it breaks structure, stop loss to break even, risk free. Trade is risk free as soon as it breaks structure, right? So we had this level of structure here that I broke through. As soon as it did that, my stop loss was at break even. That's what I suggest you do. A lot of people will tell you when you're in 10 pips profit, right, or when you're in 20 pips profit, then stop loss goes to break even. I say when it breaks structure, because that's market psychology. 10 pips, 20 pips, that's just a general thing that you can use for every trade, that you're more likely to get stopped out and then it go in your direction, you're going to be frustrated. I suggest you use this level of structure that will be each case specific, right? So this structure will say for example I enter another trade, right, at this level, right, if I just show you at this level, right, the amount of pips for it to break structure is different. That's why I'm saying it's case specific, right? So when it breaks structure to the downside, stop loss at break even. Then when it breaks structure again, well, it's basically a trailing stop loss. I'll bring my stop loss to where I say it below. And then it breaks structure again, stop loss goes here, breaks structure again, stop loss goes above that structure. So I trail my stop losses. When I have massive stop losses like this, at the beginning I had a 30 pip stop loss, you can then refine it to a 0 pip stop loss, right? And then, you know, small stop losses, but you're in profit by then, so you don't mind. So that's exactly what I suggest you do. Put your stop loss while in profit, right? So put your stop loss to a point where you're in profit and you don't mind getting stopped out, right? So trail your stop losses is the point. So that was a very simple setup. Where did I set my take profit, by the way, is what you're asking. I set it right at this level of structure and it completely smashed the TP. So if I just continue playing, completely smashed, right? So a very simple setup, 150 pips total, right? 153 pips total, right? If I use the 1 lot size for this trade, which is not even over risking your account on a 10k account, past FTMO, simple as. I used half a lot, so it was like £600 profit. So I do have £400 left on to pass the FTMO, but very simple trade, very simple setup, right? It just shows you don't over complicate the market. Just look for your Wyckoff distributions, look for where market momentum is decreasing, look for where liquidity is, and therefore where smart money wants to be taking the market, and enter accordingly. So yeah, that's about it for the video. Thank you very much for watching. I hope you've gained something of value. As I said, if you want to be added to the Discord server where the student that was, you know, taught how to trade these strategies was taught, then first link in the description, or talk to me on Telegram and I can get you added. Thank you very much for watching, and I'll see you all in the next video.